I do worry a little bit about corporate profits in the second half of this year. And one of the reasons I worry a little bit about that is that we're starting to see cracks in the economy where you're starting to see maybe the labor market slowing a little bit. You're starting to see some of the GDP numbers getting marked down, where you're seeing corporate earnings estimates starting to trend a little bit down in bulk.
Hello and welcome to WorthNet. I'm your host, Alex Daley. Today, we're joined by a regular, Chuck Carlson, CEO of Horizon Investment Services. Chuck and his team are asset managers who oversee investments from individuals to large institutions, advising on the portfolios of unit investment trusts, mutual funds, and more. Chuck, it's good to see you again.
Thanks for having me back, Alex. It's a pleasure.
So here we are, June 2025, into the third month of what some are calling tariff palooza, and stocks are higher than they were when we entered on April 2nd. What do you make of that news?
Well, I think timing is important here, obviously. And if you remember, the market, to our way of evaluating it, turned bearish on March 10th when the Dow theory, which is a tool we use, looks at the Dow Jones Industrial and Transportation averages, turned bearish, the primary trend turning bearish on March 10th. And then we had a significant decline into the bottom, which was April 8th. When you're looking at kind of the Liberation Day around April 2nd, that was right around close to finding that near-term bottom. So the fact that we've had a rally off of that, is not that unusual based on Dow theory analysis. Typically, what happens is you get the big decline after the bear market signal. Then you get a rally. That rally tends to have certain characteristics, such as they tend to last 3 weeks to 3 months, and they tend to retrace 1/3 to 2/3 of the previous decline, which, by the way, the Dow Jones Industrial and Transportation averages have met those parameters. So, it's not unusual that you do get a rally off of a pretty significant bottom. And if you remember, too, that was a real cascade market there. It was a short period of time, but that was a significant decline. And oftentimes you'll get a pretty quick rebound from that. I wouldn't peg April 2nd, Liberation Day, to be majorly significant in terms of an investor sitting there scratching their head and saying, how can the market be up from this point? Remember, markets are forward looking, and that's very important. I think that's always lost on a lot of investors. They tend to kind of base what the market should be doing by looking out the window, and the market's already long looked out the window and is looking forward. And the market probably was anticipating, at least on a short-term basis, that the tariff palooza has been delayed by, the president's continually kind of delaying and pushing back some of the big tariff implications. So we also moved into a period of time when corporate earnings became center stage. The market moves in kind of these cycles, right, where you have a lack of corporate earnings, so everything focuses on economic data. And then you get this new thing to look at, which was corporate profits. And corporate profits in the first quarter, which started to come out in earnest in mid-April, were pretty good. They were good enough. And so that was also kind of a catalyst, I think, for this rally. But more importantly, we're through corporate earnings season now pretty much. So now we're back to focusing on economic data points, tariffs, et cetera. And it'll be interesting to see how the market responds to that lack of corporate earnings information and more on some of the economic data, inflation data. Will we or won't we on tariffs, et cetera?
If I hear you right, what you're saying is April 2nd might have surprised CNN, but it certainly didn't surprise Wall Street. They'd already baked a lot of that news into the cake in March.
Exactly, which is partly why the market fell so precipitously into March, into the April lows. It was discounting what we began to see in April, which was the uncertainty around tariffs. And markets do a pretty good job of discounting.
Yeah, pretty good job. Not always perfect. I think 2008,
No.
2000 can kind of get out of whack.
And
Speaking
they do.
Right, earnings season is coming to a close. Economic data is coming around. I think consumer confidence, that's a big one that everybody watches. That was down big time in April, right?
It was and now it's come back a little bit. That it's consumer sentiment gets to be pretty relevant around market conditions. I mean, if the stock market is doing well, typically consumer sentiment will be okay. If the market is not doing well, you'll see consumer sentiment declining. And I think that's partly why we saw that bottoming out in consumer sentiment was coinciding with a pretty rough market in that March-April period. Also, too, I don't want to discount the fact that this has been a fairly chaotic, I guess would be a fair word to say, period, in that there's a lot of uncertainty around governmental policy. There's uncertainty in terms of what's going on in the world, whether it's the Middle East, whether it's Ukraine, et cetera. So there's a lot of chaos, I guess, and that will filter through to consumer confidence and consumer sentiment. My guess is consumer sentiment numbers that they'll show in May probably will rebound. Early June probably rebound because the market is rebound. I'm not sure how stable those will be. If we get another market down in July, my guess is the sentiment indicators will probably turn down. We don't invest a lot based on sentiment indicators on the short-term basis. Longer-term basis, some of the sentiment indicators can be used pretty effectively as contrarian indicators. And so when you have, for example, really, really awful sentiment, longer term, that may not be so bad for the market. You see some market, that basically that says nobody wants to own stocks, perhaps, and that means they're probably cheap, and that means you probably should start to kind of nibble on. Conversely, when you have lots and lots of investors ebullient about stocks, that tends to be on a contrarian basis, kind of a toppy period.
I hear you.
Tool, by the way, and I won't get too thick in the weeds on the tool here, but we look at a specific tool to kind of measure that sort of thing, which, for my money, Alex, is the money chart. It's the best tool that I've ever seen for giving me some sense, some perspective on market risk, on popularity of stocks on a short-term basis. And that we call it the intermediate potential risk indicator. And it looks at the percentage of stocks on the New York Stock Exchange that are trading above their 200-day moving average. So we do have some tools that I really time-tested tools that we've been using for 20 plus years that I think provide a better indication of consumer sentiment, popularity of stocks than simply some of the sentiment surveys, which I think are really short-term oriented and really get skewed by what's going on in the stock market at that point.
Yeah, if I hear you right, you're saying consumer sentiment is backwards looking in some regards. It's affected by what the market did. It's not necessarily trying to handicap what the market's going to do. Can be a good indicator for future spending, of course, though, right? If consumers feel bad about the market, they spend less on goods, which affects corporate earnings. What do you see ahead for corporate earnings, right? They've been pretty strong so far this year in spite of everything, haven't they?
They have. The first quarter earnings came out. Expectations were beaten at a slightly higher level than typically we've seen over the last 5 years. And that's important. My guess is second quarter results will probably be decent as well. The concern I have for corporate profits, and at the end of the day, corporate profits may be the strongest engine for sustained moves in the stock market. I mean, there are three primary engines, and I talk about them ad nauseum, but the reason I talk about them ad nauseum is because they matter, and that's inflation, interest rates, and corporate profits, with corporate profits probably being the most important. And I do worry a little bit about corporate profits in the second half of this year, and one of the reasons I worry a little bit about that is that, A, we're starting to see cracks in the economy a little bit, where you're starting to see maybe the labor market slowing a little bit. You're starting to see some of the GDP numbers getting marked down, where you're seeing corporate earnings estimates starting to trend a little bit down in bulk. And that's something that bears watching. And the other thing that I'm kind of concerned about is the fact that, one of the things the uncertainty around tariffs has created has been a lot of pull forward in the market in certain industries, where to get ahead of the potential of tariffs coming down the road, there's been a lot of inventory stocking up to beat the tariffs. And that has helped, I think, demand in the first quarter, will help it in the second quarter. But I just wonder if that also potentially could exhaust demand in certain areas of the economy in the second half of the year, and will that show up in corporate profits? So I think, the corporate profit picture, certainly pretty good in the first quarter, probably fine in the second quarter, but I do have a bit concerns in the second half of the year. And because the market is forward looking, which we've been talking about, the market will start to react to possibly that slowdown in corporate profits before we get to the second half of the year. It'll probably react to it pretty shortly, actually. So it'll be interesting to see. That kind of timing lines up with the fact that this rally may be a little long in the tooth, and you might start seeing the market take its cues a little bit from what it's expecting in corporate profits in the second half of the year, and that could add up to perhaps a bit of a retest of those April lows, or at least a pullback from.
That's an interesting economic sort of dichotomy we're in right now. You're talking about slowing GDP. I think that I spoke to Mish Shedlock the other day, popular economic commentator, and he pointed out a big contributor to the slowdown in GDP was falling corporate sales, yet profits have been strong, right? They've been a little bit ahead of this news. Some of the industrial sectors have been performing well as people build up their inventories. Building up of inventories also helped with GDP. But sales in general have been slowing. Consumer confidence is down. Corporate profits may be pushed forward. It sounds like you're looking at a soft second half of the year here.
I think you could be. Some softness in an economy that is still growing isn't the worst thing for a stock market. You get this kind of soft landing. You get this, people used to call them kind of the Goldilocks economy, not too hot, not too cold, just right. Some of that softening could spur the Fed to cut rates, perhaps by the September period, and that might be something that the market likes as well. So it's not necessarily the worst thing to start to see a little slowing in the economy. Here, it can be a little bit more dangerous, though, because it's not like stocks are trading at 8 times earnings or 9 times earnings. The market is not what you would call cheap here by any means. So their valuations are, reflecting a growth pattern in the future that may not come to fruition. And that's why corporate profits matter to stocks, right? So, yeah, you could see a bit of a slowing here. And if that impacts corporate profits where they're starting to disappoint, and it's all about expectations, you'll see a market pull back here probably pretty aggressively if that occurs.
What other economic indicators are you watching ahead? Is there any coming that could really sort of shake that confidence in the market and see some of the multiples that are so high right now get shaken up?
Well, I think one of the things that's coming down the pike here very shortly, actually, is the jobs report. And I think that has become very important just because that seems to be the major kind of watching of the Fed in terms of will they or won't they raise lower rates. And I think the jobs reports, the jobs have hung in there pretty well. We got an ADP number today that was not great. We'll see how that translates to a jobs report on Friday. But I think that's very important. The other indicator that we use, and I may have mentioned this in our previous discussions, Alex, is the Dow Jones Transportation Average. It's a simple indicator to look at, but it may be the most economically sensitive index in the world, quite frankly. And so how has that been performing? And if you look at the performance of that index, it had a nice move off of its April bottom. That index had gotten beaten up even more so than the industrials and the S&P, though, earlier this year into that April bottom. So it was not behaving very well relative to the other indices, which could be a tell on the economy. It had a rebound, but it's been pretty much flatlining here for the last month or so. And so while you've had some of those sexy sectors, growth sectors like technology, communication services, industrials, consumer discretionary, kind of still performing well and still putting points on here, maybe the most economically sensitive indicator, the Dow Transports, has been kind of flatlining. And so, that's something that we're going to continue to watch for cues on the economy. If, in fact, that really starts to roll over in earnest and goes back and starts retesting its April lows, that will be a confirmation that the economy could be going through a rough patch the second half of the year. And then finally, the other thing we'll be watching will be obviously some of the CPI numbers, but we'll watch them to see if this whole tariff issue is starting to really boost prices. I historically have not gotten too concerned about inflation until I've seen real wage inflation, to me has always been kind of the key to the inflation puzzle is what's going on with wages. Are they going up at a rate that's, greater than 2.5% to 3%? Are they going up 4 or 5%? To me, that's really the thing to watch from an inflation standpoint. Wages have been okay. They haven't, I know this, people listening to this going, well, this guy doesn't want wages to be going up at a fast rate. But the fact of the matter is the stock market is not a fan of rapidly rising wages because that is a real driver of the inflation story. And so, that's something that I watch pretty closely. It's what's going on with wage inflation. That has not been bad. And the inflation story actually has not been a big negative for the market. I know there's folks saying that that's going to change here as the tariffs finally start to filter through to the inflation picture. We haven't seen that yet. That could be the case. But I think overall, when you look at, again, those three engines, I think inflation, worst case, is probably neutral for the market right now. I think interest rates are probably neutral to maybe a little bit on the negative side still. The rates price the attractiveness, right, of alternative investments. And they're still offering pretty competitive rates for investors looking for risk-free returns or virtually risk-free returns, which leads us to the corporate earnings picture, which is probably positive, but one that if that starts tilting neutral or bearish, that can kind of spill over. And that's what would pull this market down. Ultimately, it's going to be about corporate profits.
Hey, it sounds like the moment to look forward to here is the start of Q2 earnings season.
Right. That's going to be important, but probably even more important. And the market will react sooner, but where I think things will start to show up, whether it's this pull forward, it's tariff palooza, inflation, is really going to be the third quarter profits, which, will start, we're still, that's an October, November event. But again, the market looking forward, 3 to 6 months, we'll start to see the potential impacts of what the market thinks is going to happen in the second half of this year, as I said prior, pretty shortly.
Now, you and I have talked before that even in a volatile market, even in a market filled with uncertainty, which it sounds like this one is, they say there's always a bull market somewhere. There's at least some stocks, some companies who are outperforming the rest of the market. In a market like this, what particular signals are you guys looking at to try to suss out what the good investments are versus the weaker ones with this economic backdrop?
Well, as you know, Alex, we have a tool that we've been using for over 20 years as a primary cornerstone of our research efforts, and that's a tool we call Quadrix, which Quadrix ranks more than 3,000 stocks. Each of those stocks we're ranking and weighting and scoring more than 100 different variables. So we have a pretty broad scope and a big fishing pond to find opportunities with a tool that can be very useful in finding those opportunities. And right now, some of the metrics in Quadrix that I think are especially relevant in this market, as I mentioned, this is kind of a chaotic market. So what would be in demand in a chaotic market would be companies that put up pretty consistent earnings growth and pretty consistent growth across the board. And one of the metrics we use is something we call earnings predictability, which looks at the company's earnings stream over multiple quarters and how predictable has the earnings growth, how measurable has been that earnings growth over those periods, and how consistent has the company been. And I'm finding that to be a very useful metric in this sort of environment. So I tend to use that pretty heavily in terms of my screening tools right now. So that's something that is working. Our overall Quadrix score, which kind of takes all of these scores and mashes them up, has been showing pretty good efficacy here as well. And Quadrix was built partly with the idea of we like stocks that can get over a lot of different hurdles, a lot of just growth, but value, operating momentum, relative price performance, et cetera. So the overall score is still showing a lot of efficacy. To kind of speak to specifically that there's a bull market somewhere, there's bull markets even within bear market sectors. One of the things that we just added to the portfolio was an energy stock. Energy has not necessarily been the greatest area to be in 2025. we've had, for the most part, oil prices have been trending down. But as you said, there's bear markets somewhere, and even in or bull markets somewhere, even in bear market sectors. And we're finding opportunities in the oil sector, for example, where companies are showing really above average growth, consistent growth, and where we can get them at pretty good valuations. So that's just kind of an example of a bull market, even within a bear market sector. Some other areas that are showing strength, that have been showing strength, and sectors that have been good this year. The one area, as I mentioned, I think on our previous discussion, is the utility sector is a very interesting sector because it kind of has one foot in this defensive area of the market, but now it has a foot in the growth area of the market because it has become kind of an AI play to play some of these utility stocks because of the tremendous power requirements to build out the AI infrastructure and to run AI at the hyperscalers, et cetera. They're energy hogs. And so these utilities are kind of in the right place at the right time. So, they have good dividend yields, 3 to 4%. They have defensive characteristics because of their regulated business. And now they're showing this newfound growth profile. And again, in an environment where it's kind of chaotic out there, and it seems like one week growth is doing well, the next week value is doing well. Utility stocks are kind of giving investors, at least right now, the best of all possible worlds. And they're showing up better in our Quadrix model than they historically do because of their numbers improving, their operating results improving.
Yeah, you don't often see a highly defensive sector like that suddenly find growth, but I think AI has proven the entire world wrong. I was looking at some statistics the other day, and ChatGPT users were 3 to 400 million monthly users back in January, and we're talking now 800 million in May. I mean, if you think about that adoption, AI is not going anywhere anytime soon. Whatever you think of the output, the hallucinations, et cetera, is definitely a big investment CapEx area.
What is, everybody keeps kind of waiting for those big hyperscalers to scale back on their spending, and they're doing exactly the opposite of that. They keep generating, and now you're getting more and more players into it, smaller companies now that are finding benefits from AI, sovereign, the sovereign wealth funds and from countries that went in on the AI. So, I mean, it is a global trend. Yes, will there be dips from quarter to quarter? There will, as any growing business. But I mean, when you have really smart people at really smart companies willing to pony up 50, 60, 70 billion dollars in CapEx spending each year, that's a pretty good sign that this is something that's going to be around. And then you start looking at, who provides the picks and the shovels for all of this, and utility companies kind of come to mind on that because they're providing the power to drive all of this. So it's an interesting group that probably has longer legs, and it's one that, again, we got into. Quadrix was kind of pinpointing that sector pretty early. It was pinpointing the other picks and shovels, the companies that build these data centers, the construction and engineering companies. Quadrix did an excellent job of highlighting those, having those companies in effect raise their hand and say, hey, take a look at us, long before it was evident that these were really AI plays. So that was a real strength of our Quadrix system in doing.
You also find yourself in really good company with those oil picks. Jesse Felder the other day pointed out quite astutely that while Berkshire Hathaway is raising tons of cash, 350 billion and counting, the one thing they have been buying is Occidental Petroleum. Hedge fund manager Paul Singer is doing the same thing. His biggest purchases have been BP and other oil companies. So you're not the only one finding bargains in that sector. Anywhere else that Quadrix has been taking you right now that surprised you?
We've kind of gotten into a company that has a kind of a data cloud business within the medical area, and that's been a nice pickup for us. So, we're not necessarily sector focused as much as bottom up stock focused, and how we get our sector weightings oftentimes is because a lot of stocks within a particular sector are raising their hands because of their Quadrix scores and saying, hey, we're scoring well in Quadrix. Let's take a look at this sector. So we don't, and we're not closet indexers by any means in terms of, trying to maintain sector weightings that are consistent with the weightings in, say, the S&P 500. Well, we don't play that game. I mean, we're just trying to find the best 30 to 40 stocks that we possibly can find. And if, 3 or 4 of those stocks are in a particular sector, we'll live with that sector overweight because, again, we're in stocks that we want to be in, that we feel are our very best ideas. The bottom line is finances, investment dollars are finite. And what you should be doing is making sure that those finite dollars are in your very best ideas. And when an idea changes or you find a better idea, get that idea into the portfolio. So we do have certain sector overweights, but those are driven primarily because we're just finding stocks that we really, really like in those particular sectors.
That philosophy has always resonated with me. Why own the entire market when you can own a handful of really great companies? For some investors, I think that makes them sleep better at night. And I think that's been a sort of a core of your philosophy. You guys have been publishing the Dow Theory letter since the Dow Theory forecast since what, 1943?
46.
You're 47. That's still a long time. You've
Long
come off
time.
by 4 years there.
Long time.
Coming up on a big anniversary there, and you guys have been managing money for more than 25 years now. So that's a lot of perspective you guys bring to the market. I just want to remind our viewers that Chuck here and Horizon Investment Services are one of WorthNet's recommended advisor partners. If you're interested in talking with Chuck and his team about managing your portfolio or a portion thereof, just go to worthnet.com/Chuck and you can get in contact with his team for a free consultation. Chuck, I want to thank you again for being here. It's always great to have you on this show. Such great insights into the market, the economy, and what to do and not to do with your money. Really appreciate it.
Thank you, Alex. It's been a pleasure.